Thank you very much, Mark and Randy, for your very thoughtful and insightful presentation. I think one leitmotif of both your presentation was the need for cooperation between the private and the public sectors. And I think this dovetails very, very well with the subject of the next panel, the final panel of this conference, whose title is Regulations, Disclosures, Financial Risks and Private Financing for the Green Economy. So I would like to invite Professor Alessandro Merli of Johns Hopkins University to take his seats on stage together with those panelists that are actually present here, who are Mr. Philippe Donnet, Group CEO of Assicurazioni Generali, Mr. Erkki Liikanen, the Chair of Trustees of the Ifrs Foundation, and Ms. Lamia Merzoukhi, co-chair of the International Network of Financial Centers for Sustainability. They will be joined online by Ms. Fernanda Necchio, now the Federal Reserve Bank of San Francisco, and Mr. Ma Jun of the China Society for Finance and Banking, and representing also the Chinese co-chair of the G20 Sustainable Finance Working Group. So, Professor Merli, you have the floor.
Good afternoon. Let me start by thanking the organizers, Minister Franco and Governor Visco, for inviting us to take part in this panel. And I would also like to thank the audience who's still here, in spite of the fact that we're about an hour late, and in spite of the obviously unfair competition from the beauties of Venice on a sunny Sunday afternoon. We'll try and be concise and make up for some lost time. As it's already been mentioned, we'll work on a hybrid scheme like a previous panel. We've already missed the Wimbledon final, but don't worry, we'll release you in time for watching at least the Euro final. Starts at 9, so hopefully I'm not optimistic there. I think we should start by saying that this is an extraordinary meeting of the G20 in the sense that a few years ago these issues may have been relegated to environment ministers, peripheral issues. Now they are front and center on the debate, and they are discussed by finance ministers and central bank governors. Finance and climate change. We try and focus now on the role of the private sector. A lot of things have already been said. The most important is that public finance will not be sufficient to meet the financing needs that are needed to reorient the global economy in a green direction. Augustin Carstens had told us that the money is there, definitely the appetite from investors is there. We've watched the boom in green bonds, ESG funds, and maybe what's new also, it's for the first time, unlike in the aftermath of the global financial crisis, there is a willingness from both regulators and supervisors and banks and other financial institutions to be on the same side, because there is a growing awareness that this is a recognition that it's a common problem, and that climate risk is, as President Lagarde said, is a financial stability risk. It's a financial stability risk for the system and for individual financial institutions. We'll move a bit from the macro to the micro picture. Governor Carney has given a lot of numbers already. Private sector institutions know that they have to set up the right governance, the right strategy. In terms of governance, we watched what happened at Exxon. More and more companies are including ESG or climate experts in their boards. Strategy, risk management tools to deal with climate risk, and metrics, which is something that we'll talk a little bit about in this in this panel, not least, maybe consider peripheral issues, but not least in measuring executive performance and executive compensation. We'll look at some plumbing issues in the markets. This is not a glamorous thing, it's not a pleasant thing sometimes, but anyone in Venice will tell you that it's an essential issue. So a little bit of plumbing, and I'll give immediately the floor to our first panelist, the CEO of Generali, Philippe Donnet, who will start speaking not just on behalf of Generali, but on behalf of a group of some of the biggest insurance companies. I think Governor Carney has already alluded to that, but I'll let Mr. Donnet explain what insurance companies are trying to do, practical steps to address these climate issues. Mr. Donnet.
Thank you. Hello, everyone. And thank you to Mr. Franco and Governor Visco for inviting me to address the G20 finance on behalf of the whole insurance and reinsurance industry. It's a real honor for me to be with you today. We all know that climate change is the biggest challenge we face as a society. We are talking about an emergency that requires not only our full attention, but most importantly, our urgent action. The last decade has been the warmest one ever recorded, and 2019 was the second warmest year on record, with the greenhouse gases in the atmosphere rising new highs. While the measures to contain the global COVID-19 pandemic and the subsequent economic downturn may have resulted in a short-term drop in greenhouse gas emissions, obviously it was unfortunately only temporary. No country is immune to climate change. Lives and economies are being affected. Sea levels are rising, and weather-related damage is becoming increasingly more extreme, both in terms of frequency and intensity. In 2015, the adoption of the Paris Agreement aimed to catalyze a global response to the climate threat by limiting global warming to 1.5 degrees Celsius above pre-industrial levels by the end of this century. This will require a transition of the entire economy, with companies adjusting their business models, developing credible and ambitious plans, and most importantly, implementing them. The insurance and reinsurance sectors can play and have to play an important role in accelerating the transition to a resilient net zero emissions economy in line with the 1.5 degrees target. This is exactly why today here in Venice, 8 global insurance and reinsurance leaders, together with the United Nations Environment Programme, are making a historic commitment by launching the Net Zero Insurance Alliance. These are Allianz, AXA, Aviva, Munich Re, SCOR, Swiss Re, Zurich, and of course, Generali. And I'm truly honored to both announce and represent here the Alliance as its ambassador in this G20 finance meeting in Venice. Our goal is to transition our insurance and reinsurance underwriting portfolios to net zero emissions by 2050, in line with the 1.5 degree target of the Paris Agreement. Through our core insurance and reinsurance business and guided by climate science, we are determined to make this alliance achieve a greater, longer-lasting impact and contribution to economic, social, and environmental sustainability. The Net Zero Insurance Alliance builds on the climate leadership of institutional investors, such as insurance and reinsurance companies and pension funds, via the United Nations convened Net Zero Asset Owner Alliance, whose members have already committed to transition their investment portfolios to net zero emissions by 2050. After all, it is in the nature of the insurance and the reinsurance industry to have a long-term vision and to exercise preventive measures for what might be perceived as huge risks in the future. Also, as both investors and insurers with operations all around the world, we, the founders and future members of this alliance, are in a position to have a positive influence on our many stakeholders. For example, we can engage with our clients and potential clients with significant greenhouse gas intensive activities and help them with their decarbonization strategies and net zero transition pathways. We can develop and offer insurance and reinsurance solutions for low emissions and zero emission technologies and nature-based solutions that can absorb greenhouse gas emissions. And last but not least, we can advocate for government policies for a science-based and socially just transition of economic sectors to net zero. One thing is clear: to successfully tackle climate change, we must work, decide, and act all together. The G20 and the world's governments, the United Nations, the private sector, and society at large. And we need to accelerate, as the climate emergency is a race against time, and it's a race we just cannot afford to lose. We are committed to make the Net Zero Insurance Alliance a truly global one, and we want to involve more insurers and reinsurers, as well as insurance brokers and other insurance market participants in this journey to a resilient net zero emissions economy. In a nutshell, the whole insurance and reinsurance industry is committed to tackle this unprecedented challenge posed by climate change and to build a safer, healthier, more prosperous, more inclusive, and more sustainable future for all of us. Thank you.
Thank you, Mr. Donnet. It's actually hard to overstate the importance of the insurance sector in this area as both insurer and investor. I'll give you now the floor to Erkki Liikanen, who's chairing the IFRS Foundation and is known to many of us also as former governor of the Central Bank of Finland, but he was also a EU commissioner, a minister, and he has a long history with climate change, but with the measures for countering climate change. But in this case, we can say that data is key, disclosure is key. We were told by the FSB chair that investors need a map, a roadmap, and I think disclosure standards will be completely essential. So is there a path for global standards for disclosure on sustainability, and what is the role for governments, and what is the role for the international standard setting bodies?
Thank you very much, Alessandro. I also want to thank host for the invitation, hospitality, and also great content of this event, including the issues papers which came beforehand, which are very good, concise presentations of the issue. Sustainability, including climate reporting, is a very broad discipline, ranging from jurisdiction requirements for companies to report against specific policy objectives, up to investors' need for global comparability of sustainability-related financial disclosures. These all are important, but the focus of IFRS is to meet the information needs of investors. I think that there's a path to global sustainability standards if we can create a global baseline of sustainability-related disclosures to facilitate comparability for investment decision-making, and at the same time work with the jurisdictions to ensure compatibility between this global baseline and their own policy initiatives. Mark Carney referred in his recent famous book, Values, to the tragedy of the horizon. He defines 3 pillars for the solution. First is public policies, second, company transition plans, and third, disclosures of climate-related risks and opportunities. I think that's a good division. Governments and jurisdictions are required to establish clear policy frameworks. Investors price investment capital based on how those policies will impact companies in the long term. This in turn provides companies with an incentive to embrace sustainable business models. The efficiency of the supply chain is dependent on high-quality, globally comparable information on which investors can assess sustainability risks and make informed decisions. This is the role of investor-focused international standard setters such as Ifrs Foundation. It is to enable the achievement of policy objectives by developing standards that bring consistency and transparency for the global capital markets. The separation of roles and responsibilities is made elegantly clear by Jean Tirole in his book, who emphasizes that economics is a science of means, not of aims. Common objectives of society largely rely on values, and governments determine the objectives. Economics and the market can in turn provide means to meet the objectives at the lowest possible cost. Similarly, disclosure standards do not set the policy objectives, but they can be a valuable instrument to support the delivery of those policy objectives. When sustainability reporting can be asked to promote broad policy objectives, the responsibility belongs to elected bodies and institutions. But an additional question has been raised whether for a more limited task to provide sustainability-related disclosure for investors, global standards would be needed. This question was often put in front of the Ifrs Foundation because its financial reporting standards are required for use by more than 140 countries. Ignacio Visco and Janet Yellen spoke about the years 1997, 1990, after Kyoto Protocol, exciting period. Just a little later, in 2000, 2001, Ifrs Foundation and International Accounting Standards Board was founded by IOSCO's support. Paul Volcker was a great player in that game. Interestingly, at that time, financial reporting and climate change did not meet. Of course, USA had pulled out of Kyoto Protocol. Now in 2021, it has all changed. Ifrs organized last year a consultation for the strategy review where the focus was on just sustainability reporting. And we started with 2 questions. The first was, is there demand for global standards? And second, if so, should the Ifrs Foundation to play a role in developing such standards? And our conclusion was, even beforehand, that we are ready to serve only if needed, if there's demand. The responses showed a growing and urgent demand for a single set of global sustainability-related disclosure standards. And a great number of commentators also wrote that Ifrs Foundation should play a role in developing these standards. Internationally, there are a number of voluntary multi-stakeholder standards and investor-focused initiatives. The organizations behind these initiatives affirm that consolidation is required. They have welcomed the proposals to establish a new International Sustainability Standards Board within the governance structure of the Ifrs Foundation. And the shared ambition is to introduce a global baseline of standards for sustainability-related disclosures, which are focused on meeting the information needs of investors globally when assessing enterprise value. Enterprise value is a key concept designed to capture expected value creation for investors in the short, medium and long term. And it is interdependent with value creation for society and environment. Actually, Randy Qualls quoted also that the new board would begin with the climate. Its work would be expected to move with pace to consider other sustainability-related issues important for enterprise value. But any further step would require investor needs and the support in global stakeholder consultations. And our approach to global standards is market and demand-led. The Foundation provides a setting where investors, regulators, companies, academics and standardists from around the world can work and problem solve together. The question about governance of IFRS has also been raised. Key part of the governance is a transparent and inclusive due process that is overseen by trustees. And the trustees are in turn accountable to the monitoring board of public authorities, and its membership includes IOSCO, the European Commission, the US Securities and Exchange Commission, and other authorities. Basel Committee and IOSCO are observers. Whilst the Foundation is responsible for the production of IFRS standards, individual jurisdictions retain the right to choose whether and how to incorporate the new standard into their own requirements. These governance arrangements have evolved over time. The trustees are currently consulting on further amendments to the governance and constitutional arrangements to accommodate the new Sustainability Standards Board. We welcome any suggestions for further enhancement. If the future is jurisdictional and international standards, the key question is how this can be reconciled. And I want to conclude just by saying that the approach advocated by IOSCO and others is to establish a global baseline of sustainability-related disclosure standards to meet investor needs, which would be made available for use by jurisdictions as a base for public policy needs. This approach would provide global comparability for investors in a way that allows jurisdictions to combine the global standards with their own additional requirements. And I actually agree with Paolo Gentiloni when he spoke today that to make this work will require political will, compromise, flexibility from all parties. Success is by no means certain, but if you want global sustainability-related disclosures for investors, this offers a path. Thank you.
Thank you, Erkki. I think you rightly put the accent on comparability and on the compatibility that there needs to be between global standard and regional standards also. Otherwise, we've seen occasionally with accounting standards that can be, sometimes there can be a conflict, and that is quite troublesome. So there needs to be a reconciliation in sustainability-related matters, if I understood you correctly, to avoid a cacophony and to avoid further problems. Now, our next panelist comes to us via our connections. Hopefully she will appear shortly behind me. Here she is, Fernanda Necchio. I hope you can hear us fine. And
yes.
Fernanda is with the Federal Reserve Bank of San Francisco, and it's not unique. It's been mentioned that Carney was governor at two different central banks, but Fernanda has a different distinction. She has served in two different central banks, one in a developed economy and the other one in a major emerging market economy. So provides a bit of different perspective. She's at the Federal Reserve Bank of San Francisco, but she was also on the executive board of the Central Bank of Brazil, which is her native country. And so it has a very interesting perspective. We've already heard from President Lagarde and from Governor Visco earlier in an earlier session that climate change is important for central banks in terms of monetary policy, but also in terms of supervising banks and as a guardian of financial stability. I think it would be interesting to hear from you, as you have this double experience on both sides of the divide, if I can put it this way, how you tackle this in both your jobs.
Great. Well, thank you very much for this nice introduction. Good afternoon, everyone. And thank you for the invitation to participate on this panel. So I'm planning to give some brief remarks and really be very brief and focus on two main points, which first I'll talk about why climate change and the risks associated with it are important for central banks. And in fact, they are at the heart of central banks' mandate. And this is going to be a very important point as I go through my planned remarks. And then I'll finish by laying out the importance of research and good quality data to better understand and meet the challenges of a changing climate. I think this is a good time for me to start saying that my remarks reflect my own views and not those of my current employer, the Federal Reserve Bank of San Francisco, and neither my previous employer, the Central Bank of Brazil. That said, in many ways, my views are shaped by having participated on the efforts to understand and mitigate climate risks and foster a greener financial system on these two very different central banks and economies. So turning to the first point, why are climate risks so important for central banks? And I think we heard a lot about that during this nice conference today. Well, first, most central banks are committed or mandated to keep inflation low and stable. To do so, the central banks conduct monetary policy based on current, future economic conditions, inflation, and inflation expectations. Therefore, it is really important that central bankers understand the underlying mechanism that determine economic conditions, how agents respond to risks and shocks, as well as how they respond to current and future changes to the economy. So central banks are forward-looking and need to follow closely and understand the nature of shocks hitting the economy, as well as the undergoing changes to households and business preferences, to consumer patterns, and changes to investment decisions. So those changes are going to be important drivers of economic conditions, trends in labor markets, and also have very important effects in relative prices. In the past few years, on top of the increasing number of extreme climate-related shocks, we have seen an increasing response of consumers, businesses, and investors as they adjust their preferences and behavior and adapt consumption and investment patterns to respond to current and future changes to climate conditions. So the shocks per se, but also the changes and adaptation of economic agents are bound to have impact on the economies worldwide, although in different ways, right? You can think that, for example, for emerging and more open economies, the effects can be felt stronger from changes in financial investor preferences, for example, while for larger and more closed economies, countries can be more heavily impacted by the responses of businesses and consumers. So in order to fulfill their mandates to keep inflation low and stable, central banks need to stay ahead of the curve, prepare for and understand the structural changes that their own economies and other economies are going through. Therefore, understanding changes to agents' behavior due to climate risks and how the transition to a newer equilibrium affects their economies is undeniably at the heart of central banks' objectives when conducting monetary policy. Some central banks also have mandates associated with safeguarding the stability of their financial system. As climate-related extreme events become more frequent, they put financial systems at risk, directly and indirectly, and climate risks and the response to it may change the demand for currency, the values of physical assets and collaterals, in addition to bringing high financial costs to the society. So once again, preparing and mitigating climate risks becomes an important task for regulators and supervisors. Note that everything that I've said so far are associated with climate risks having direct and indirect effects on the economy. And for those reasons, climate risk and climate change is a matter of interest for central banks. Understanding and laying out the appropriate responses are key for central banks to fulfill their mandate, irrespective of whether climate is explicitly stated in their mandates. The importance of better understanding the economic impact of climate change and how to respond to the economic changes induced by it brings to my second and last point, which relate to the roles of data and research. One of the main challenges to study the study of climate relates to bridging data gaps. We have observed changes to climate and the emergence of risks in the past few years, but we have yet to attain comparable data sets worldwide, converge on metrics to measure risks, and the responses from market participants. And very importantly, we have yet to measure to make sure that databases worldwide speak to one another. In addition, climate change is a global phenomenon, and in being so, it requires a strong international cooperation, information sharing, and consonance of data and metrics. These elements are going to be key for central banks going forward to better understand and respond to the challenges ahead. So, what exactly can be done with data research? In the same very structured way that central banks worldwide rely on academic research to study and implement monetary policies, academic research on climate change should be the base and provide the stepping stones for the response of central banks going forward. A lively academic environment is key for providing fruitful discussions and for constructing a well-grounded response to climate change. Bridging data gaps and fostering the excellence in academic research is key to face the challenges ahead. With that in mind, the Federal Reserve Bank of San Francisco is convening the best academic thinking on the topic, hosting conferences and sponsoring a seminar series on climate economics, featuring a wide range of research on these issues that stand before us. The Federal Reserve Bank of San Francisco has also assembled a research team, which I am leading now, to study how these issues are likely to impact the Fed's mandate in the future. This team will allow central banks, the Fed, and also central banks worldwide to leverage our strength as students of the economy and to prepare for the challenges and uncertainty that lie ahead of us. Thank you.
Thank you. I think it was important that you brought up the importance of bridging the data gap in terms of understanding the risk that come from climate change. I forgot to mention, and I should have, that something that not many people know it, that the Central Bank of Brazil was voted by, surprisingly to me at least, by a group of NGOs active on the environment and the second best in the world in looking at these topics. And you were involved while at the Central Bank of Brazil in looking at the sustainability aspects of the banking supervision. As Brazil is such a crucial country when we talk about environmental problems and climate change, I wonder if you could tell us something about that, the reaction, the response of the banking sector there, which has some very important institutions to your efforts.
Sure. I don't know if you want me to respond right now or to come back later when we have a Q&A. So, I mean, I can...
Yeah, if you could answer that now.
All right. So I actually don't feel that it's surprising that the Central Bank of Brazil has a very comprehensive agenda on climate and the mitigating of social, environmental, and climate risks. In fact, you know, the Central Bank of Brazil was very, in some ways, pioneer in establishing regulatory and supervisory measures to try to mitigate and foster a greener financial system. But in last September, when I was still at the Central Bank of Brazil, the bank launched a very comprehensive agenda that included measures related to internal measures, policies, specific policies, partnerships, supervisory and regulatory measures. In very broad sense, all measures announced by the BCB are related to disclosure and mitigating the climate, social, and environmental risks. And turning straight to your question, the reception from the financial sector was actually very positive. I think it's a growing consensus in Brazil among the financial sector and among consumers as well. And that goes back to the type of changes in behavior that I was talking about a few minutes in my initial remarks. And there is a demand from the society to foster a greener financial system in the country. And we saw with the launch of our agenda that the financial sector is really engaged and committed to responding in the best way to the regulatory measures that have been put in place and that are being put in place over the course of this year. I would also say that everything that has to do with the Brazilian agenda is available online. So if you want to read the details about all the measures announced, the deadlines, and how things have been evolving since the announcement, I would refer everyone to the BCB's website to check it out. As much as I'm not part of the BCB anymore, I'm very proud of what they have been doing over there.
I'm sure you are. Our next is a testimony to our diversity. We can boast in our panel the only non-G20 speaker today, and also the only one from an African country. Lamia Merzuki is with the Casablanca Finance City Authority, and she also co-chairs the International Network of Financial Centers for Sustainability. And I think she can tell us a little bit about how can the low-carbon transition shape financial institution markets in the context of developing emerging markets and developing economies, and exactly what you do as financial centers for sustainability.
Thank you, Alessandro. Good evening, everyone. I'd like to start by thanking and congratulating the Italian G20 presidency for its continuous leadership and support. I mean, you have been instrumental in the FC4S launch 4 years ago within the framework of the G7 Italian presidency, and you have been continuously committed to the development of this network, including the African Regional Platform. So thank you for that. So the FC4S, the Financial Centers for Sustainability Network, is the network of the world's green financial centers born out of the G7 Italian presidency in partnership with the UN and today with the UNDP. It represents over 80% of the global equity markets with 36 financial centers in the world from across Europe, the Americas, Africa, Asia. And it was launched in African grounds in Casablanca with the signing of the Casablanca Declaration. So the purpose of this network is to mainstream green finance and to really green the financial systems in every country. You know, there is a unique characteristic that a financial center offers. It's not only a network of banks or a network of insurance companies. It's the synergy of a whole ecosystem of actors, be it banks, insurance companies, asset managers, and even the supervisors, the regulators. So having said that, how this network is concretely contributing to the greening of the financial systems? Actually, this is done through multiple ways. The first way is by supporting the financial centers in their sustainable finance roadmap, and even sometimes helping the countries put in place their sustainable finance roadmap from scratch. But there is a process for that. So let me very briefly talk about a major tool that we have put in place in the FC4S, which is called the assessment program. This tool actually takes a form of a survey that we send once a year to the financial centers, members of the FC4S. And the purpose is to provide the financial centers with a baseline to track and measure their progress in terms of sustainability. So it gathers a lot of quantitative as well as qualitative data, and obviously here data is crucial. I mean, as it has already been said, if we manage to show the progress using data, then we could really make a real change and gain momentum. So obviously here the taxonomy issue is crucial, but we can discuss it later on. So once we gather all this information and analysis, then we can design a strategy and a sustainable finance roadmap. So this has been the case for many countries, and very recently with Malaysia, with Ireland. So for instance, the Irish Ministry of Finance is currently developing its first sustainable finance roadmap using the assessment tool, the FC4S assessment tool. We are also working in partnership with the Coalition of Finance Ministers for Climate Action, and we have been developing an international stocktake on sustainable finance roadmap that will be like a guidebook for ministers of finance. So today, this tool is really becoming an unmatched global reference of where financial centers stand in terms of sustainability, both at the public and private sector levels. The second way to contribute to the greening of the financial system is through international cooperation and multilateral action. And here, I'd like to share what we're doing in Casablanca, in Africa. In Africa, because actually the first regional platform that was launched was that of Africa, and then we launched Europe, the Americas, Asia, and so on. Obviously, in Africa, the process was not that easy because by and large, Africa is still at a very early stage of the sustainable finance transition. But the FC4S has made a special effort to agree a specific work program dedicated to Africa because it represents the weakest link in green finance, and yet it has the greatest potential to make massive leapfrogs in terms of sustainable development. So today I'm also representing Casablanca Finance City, which was at the origin of the FC4S African chapter, and we were the only member in the African continent. And today, 4 years later, we are six members in this FC4S African chapter, and I must say it has been a great learning experience with several partnerships. We have talked, it has been mentioned, ambition and cooperation, and this is, Africa, the FC4S African chapter is about international cooperation. Even bilateral cooperation. So for instance, Casablanca Finance City signed a partnership agreement with FC4S Lagos to accelerate the implementation of the SDGs, their respective SDGs. And what is unique in the FC4S is that it has been a catalyst for the emergence of new financial center bodies that adopted sustainability as a strategic priority in their DNA from the start, namely Abidjan, Lagos, Cairo. Lagos, the name of the financial center is FC4S Lagos, Financial Center for Sustainability Lagos. Obviously, sometimes it was very, very challenging because we have very diverse levels of development in terms of sustainable finance. And sometimes, to begin with, it was just about capacity building and raising the awareness in some countries, just raising the awareness and rallying the stakeholders around green finance, public as well as private, and explaining that the future of finance can only be green and sustainable. I have some, or maybe later on, just on the framework, standards, and so on, taxonomies. For sure, without harmonized framework, the mobilization of green investment flows is blocked and investors are lost. But at the same time, I believe it's important to identify and prepare for the possible unintended consequences of the convergence of the taxonomies. And here I'm talking about all the indirect impact that these standards, frameworks could have on developing countries. I mean, what could seem like an easy rule and framework to implement in a mature economy could end up jeopardizing a less mature economy. So I really think that we should consider regional specificities, and we believe that this can be done through the well-established international practice of international recognition, I mean mutual recognition and technical equivalence. So for instance, finding an acceptable ratio for adapting sustainability standards to different countries in the world. I'm in contact with many African countries that find it very difficult. Just as an example, we have some African countries that are still dependent on coal. Okay, they are poor countries, they are the least pollutant, but they are still dependent on coal to produce electricity. But international reinsurers are reluctant to give any capacity, and they find it so, I mean, they cannot afford a price too expensive. So it drives the country to a troublesome situation. So is it sustainable? Is this situation sustainable? I'm not sure. That is why I think that we should really work on adapting, all these frameworks. I mean, I'm a fierce believer of rules, standards, and frameworks. All I'm saying is that we really need to adapt these frameworks to regional specificities, at least. Thank you.
Thank you. I think this is why meetings like this are important, because they bring out voices that sometimes have difficulty in being heard, and bring out differences which are important, especially in the transition, and as almost everybody emphasized, the importance of having on board emerging markets and developing economies. This is a graphic representation of problems ahead and need to be tackled. We should once again have a panelist from the outer world, from some other orbit. Here you are, Dr. Majun. Is good afternoon. It's probably good evening to you, or good night, but you're the chair of the Green Finance Committee of the China Society for Finance and Banking, and you're also the co-chair of the G20 Sustainable Finance Working Group and a former central bank official. Thank you for joining us today, and we're keen on hearing from you on the work of the Sustainable Finance Working Group. As we've heard from the FSB, which I know you work closely with, but in your work, we'd like to hear about your work in developing a G20 roadmap on sustainable finance. I think this is one other instance where we see the importance of the G20. Climate change is clearly not an issue that can be solved by developed countries alone, and the fact that China co-chairs or a Chinese representative co-chairs this group, I think underlines the importance of the G20 effort. Dr. Majun, the floor is yours.
Thank you very much, Professor. Can you hear me okay?
Yes, very well, yes.
Great. Let me start by thanking the Minister of Finance and Central Bank of Italy for inviting me to join this very important forum. It's my great pleasure to be part of the discussion. As many speakers have touched upon the importance of green and sustainable finance, I will focus on my remarks on the question of how. Based on experiences of the past few years in the sustainable finance market, I think a well-functioning sustainable financial system will need to have at least 4 pillars. The first pillar is taxonomy. Taxonomies, which define what are sustainable activities, is the basis for all sustainable finance activities. Taxonomies can help prevent greenwashing and protect market integrity and provide a basis for green performance measurement and allocation of government incentives. There are several different approaches to developing such taxonomies, including the top-down approach, which was adopted by China, EU, and a few other countries, and bottom-up approach, which is used by climate bond standards. Of course, taxonomy is not only tool for aligning investments with SDGs. Its implementation requires the assistance of verification services and green or ESG rating methodologies. The second pillar is disclosure. Green and sustainable finance should deliver environmental and other benefits to SDGs. These benefits should be calculated and measured and reported in order to inform investors that are interested in investing in sustainable assets. As exposure to polluting and high carbon assets can generate financial risks to investors, such environmental and climate risks should also be measured and disclosed. In the past few years, many governments and regulators have introduced their environmental and climate-related disclosure requirements based on TCFD recommendations. The third pillar is incentives. Under the current pricing system, many sustainable investments are not fully compensated for their positive externalities, which leads to underinvestment, and many polluting and high carbon investments have attracted too much capital as their negative externalities are not fully internalized. Therefore, public policy tools need to be used to overcome these externalities. These tools include emission trading schemes, carbon taxation, policies encouraging the use of clean energy and other low carbon activities, as well as green finance incentives. The fourth pillar is financial product innovation. A green financial system requires many products in order to meet the demands from different companies and projects. We need green loans, green bonds, green funds, green ABS, green ETF, green insurance, and carbon-related products. Each of them will play a role in supporting certain green and sustainable activities. A lot of progress has been made in the past few years in the sustainable finance market, especially in these four areas, which I call four pillars. The question for us is what the international coordination mechanisms, especially the G20, should do to further accelerate the pace of its development. This is exactly the question of the G20 Sustainable Finance Working Group is trying to answer. Over the past few months, this working group, re-established by Italian presidency and co-chaired by myself, representing PBOC, and Sharon Young, representing US Treasury, has held 2 official group meetings and many consultation meetings with private sector representatives and IOs. We have decided to produce 4 major deliverables this year. The first is a G20 Sustainable Finance Roadmap, which will come up with recommendations on many of the issues I mentioned above. And this roadmap will guide the work of G20 for the coming few years. The second, third, and fourth items are topics the working group will work on this year, including approach to align investment with SDGs, sustainability reporting standards, and roles of MDBs in supporting the Paris Agreement. Let me just give you 2 examples on the issue that we need to have global coordination, including through the G20 Sustainable Finance Working Group. The first is about the approach to align investments with SDGs, which include taxonomies and ESG rating methodologies. One problem we're facing is that as many as 200 taxonomies have popped up over the past few years. This is equivalent to 200 languages used in the same market for communication, which creates market confusion and segmentation, increased verification costs, and potentially may lead to greenwashing. As for ESG rating, they are also facing the problem of too many inconsistent methodologies. The second example of issue that requires global coordination is sustainability reporting. There are many different types of reporting standards or proposals developed with different principles, different content requirements, and presentations. The proliferation of inconsistent reporting standards is also becoming a barrier to enhancing transparency and data availability. In the above-mentioned areas, we need to come up with solutions to improve coordination and consistency. For example, we can encourage developers of taxonomies to use the same industrial classification, encourage different jurisdictions to adopt common taxonomies on a voluntary basis, and encourage the development of unified regional taxonomy, just like what EU did for the European market. As for reporting, we should support the IFI's efforts to develop a globally accepted standard, reporting standard with flexibility to accommodate jurisdictions and SME-specific requirements. I'm very hopeful that through our collective efforts, the Sustainable Finance Working Group will make concrete progress in the coming few months to forge consensus in many important areas that require global coordination. Thank you very much, and back to you, Professor.
Thank you. Thank you very much. I think you touched on many questions that had popped up in the conversation earlier today, and there's one last point that you mentioned that I think it's worth repeating, and that's the treatment of SMEs, because of course these risk being left behind, and if not assisted in the transition, and these are the backbone of many economies, including the one in Italy and many others, and the question of proportionality and assistance will have to be taken into account. I don't want to rush things through, but we have time for some questions, and one comes from the Deputy Governor of the Bank of Canada, who would like to take the floor. And I think I'll give the floor to her.
Thank you,
If she's
Alessandro, and
or to him, I'm
thank
sorry.
you for allowing me to speak here. This has been a very, very interesting panel. I think even the whole day, and I really want to thank also the Italian presidency for kind of organizing this day. This has been great. I think there's been a lot of kind of a general feeling that people agree with the same messages here, where we're really at an important juncture. If we want to get to net zero, we really have to act now. That's a really important aspect. We really need the private sector, and that's really the aspect of this panel. There's all this set of kind of what I'll call necessary conditions, and I think Marjun kind of covered quite a bit of that. We really need kind of proper pricing. We need disclosure. We need data. We need the taxonomy. These will not be easy aspects to get. At least in the Canadian case, we know a lot of parts where we're seeing different adjustments there. In the pricing part, we're moving forward with carbon pricing. But at the same time, the distributional aspects of that are very important. Even in a case like Canada, where we're using the revenues to kind of help redistribute, that doesn't mean it kind of works perfectly. I always think there's a big difference between suburbs and cities and different groups. We're actually we're trying to change behavior, and so certain types of behaviors are kind of basically being asked to do differently, and that means certain parts of the society are kind of being asked more. Disclosure is really an important piece there too. We're working very heavily on the disclosure in Canada, and right now we have a pilot project with a whole set of banks, insurance companies, pension funds. And as been discussed, this aspect of looking forward and trying to get forward-looking metrics, and we're exactly working with that. We're working with some of the scenario analysis from the NGFS to kind of try to prove that. It's turning out to be quite difficult, and it's actually very demanding on the institutions to do that. But I think we can kind of help that learning, and we're trying to move forward there. Data gaps is really one of the big things that has kind of been brought up. Again, there, I think has to be a big role in kind of getting data to be shared across countries, and kind of hoping that we could treat some of that data like a public good. Also on taxonomy, we want to be ambitious. We want to kind of figure out things, but we have to be practical. And again, trying to figure out the right mix and thinking about some of the distribution aspects of some of those taxonomies, who will be hurt or not, and whether we'll keep enough social support. So those are all the things I think there's been a big agreement here in most of the presentations today, this aspect of pricing, disclosure, taxonomy. So my question for the panel is, are we missing something? Is that sufficient to kind of really concentrate on those elements and then let the private sector be able to kind of move forward financing if we're working on those? Or are there things that we're really missing there? Or is there subparts in those aspects that we are also missing? So that's my question for the panel.
Perhaps I could say, yeah.
Yes. Erkki, why don't you take that? And I think we've heard about the Canadian example today, and as a reference, and we heard also it's not all smooth sailing, but it's it's a first step. And then to the question of Deputy Governor Budry.
Of course, today we've discussed from the morning on this carbon tax issue. It was by Nordhaus, it was by others. I have in one of the slides of Professor Nordhaus was Finland on the top. It was the highest carbon tax, but not very large scope. Just I know a little bit about the history because I happen to be finance minister who proposed that in 1988. So it was imposed from 1990. It still is there. It was the first of its kind. Why it was possible was that we at the same time had income tax reform. So we were able to balance these distributional impacts on income tax reform. I must just say that however positive approach people have to fight against climate change, these distributional aspects come into play relatively soon. So they must be at the same time properly handled. And I'm sure the Canadian friends have a lot of experience, and every single country needs to work on that. That's one issue. And second is then this leakage issue. This kind of question of climate club is, I think it's necessary. Bruegel, the European think tank, has made also a paper about that. I just agree. It's not a home run. It's an important project, and I agree with that. I think second issue, which is very important here for us, is to define the roles, who does what. That's why I think we must remember that, for instance, central banks have not a mandate from elected people to run climate policies. So it must be mainly done by governments who have legitimacy of the parliament. But then, of course, in their own remit, they have important roles for financial stability, how they impact inflation forecasting, and so forth. For standard setters also, when they ask about our governance, what is our governments to take the issue up? I said, we are not setting up policy objectives. It comes from governments, from elected bodies. But we can propose tools and instruments to achieve those in the most efficient ways by using market mechanisms. But I think in this discussion, it's been a great day and great presentations, good papers, but still to have this structure, who does what, who is responsible for what part, and still not forgetting the areas, Africa, different circumstances. SMEs has been a very powerful case here. Larry Fink spoke about private companies also. We also need to think about its breadth, not to focus too narrowly on public companies, because otherwise you lose such a big part of the economy. But maybe others too, but it's been great, absolutely great day. Still, I said, William Nordhaus' presentation, brief, well-structured, all the key points were there. That was a great start for the day.
Thank you, Erkki. We have another question online comes from Kevin Gallagher. It's a question for Ms. Necchio, who underlined the need for global surveillance and coordination. And he's asking, I hope Fernanda Necchio is still with us. He asked, the NGFS is pioneering efforts in assessing future climate risks. Could the IMF extend its role and take into account these progresses to upgrade its role as a financial supervisor? So I assume he means upgrade its role as a financial supervisor to take into account climate risk as a financial risk. I hope Ms. Necchio is still with us.
Yes, I'm here. So okay. I think, well, first, the NGFS has a key role in this global effort and actually bringing awareness and providing tools particularly for smaller economies to handle the effects of a changing climate. I believe the IMF has been increasing as well its efforts in the discussions associated with climate change and the effects on the economy. And I believe we're going to be seeing more and more of that going forward. So because the efforts regarding climate have to be from a global perspective, international organizations are going to be key here in trying to coordinate the responses and also setting patterns and directions for countries to move forward. So I think the IMF is one that is going to play an important role as well.
Thank you. Indeed, we've had a very bullish message in terms of involvement of the IMF from its managing director earlier today. We're fast running out of time. I don't know if there's any questions from from the room. Otherwise, instead of trying to draw conclusions, which of course will be left to Italian Minister Daniele Franco right after this panel, I just wanted to ask Mr. Donnet, this time donning his hat as resident of Venice and CEO of Generali rather than spokesman for this alliance of insurers, because I know, Generali is sort of making Venice as a center for sustainability studies. Maybe he can tell us a little bit more about that, and then after that we'll hear from Minister Franco.
Thank you. Yes, as you know, as Generali, we share with the city of Venice the same symbol, which is the winged lion of San Marco, and this is really important to us. Venice celebrates this year its 1,600th years anniversary, and in the same year as Generali, we celebrate our 190th anniversary, which means for us 119 years of presence in Venice. So Venice has a special place in our long history, in our company, and obviously in our heart. But the place of Venice for us is not only in the past, in our history, in our heritage. Venice is also part of our future. Venice has a special place in the world, and everything which happens in Venice happens to the whole world. So this is the reason why we decided a couple of years ago to revitalize the San Marco area, doing with two sustainable initiatives. The first one was to bring back to life the Royal Gardens, the Giardini Reali, which are between the Laguna and the San Marco Square, and they had been abandoned for hundreds of years, and they are now a green, relaxing haven open to Venice citizens and Venice visitors. The second initiative is the restoration of the iconic building of Procuratie Vecchie. Maybe you have seen it on San Marco Square. It's a huge building, still under construction, under restoration. We will host in this building the head office of the Human Safety Net, which is our social initiative to unlock the potential of people living in vulnerable circumstances, because we believe that a sustainable world is also a more inclusive world. So we wanted to make those two initiatives together, because we are convinced that fighting against climate change and fighting for a more inclusive growth is the same thing. It's the same fight. And I think to win this battle, we all need to raise our sense of responsibility, our level of awareness, and our level of consciousness. This is exactly what the story of Venice have taught us during hundreds of histories, and I think that this is exactly what the G20 has just been doing. Thank you.
Well, indeed, if there is a prime example of the threat from climate change and the need to act on it, is definitely the fate of Venice, and I think it was very appropriate that the G20, and in particular this conference, was held here. I now give the floor to Minister Daniele Franco for the conclusion of this conference.